Welcome to the Public Raise podcast. I'm your host, Paul Carson Willis. Today, I have with me Greg Stula, who is the CEO of Real Street Capital, a space that is exceptionally popular with the retail investor in the CF and Reg A. Welcome, Greg.
Thank you. Thank you for having me, PKW.
No problem. Interesting sector that we will touch on in a second about what Real Capital is doing, or Real Street Capital is doing. But you didn't start off in real estate. You started off working for Coopers & Lybrand, I understand. Can you tell me how you went from something like Coopers & Lybrand to starting up a business like Real Street Capital?
Yeah, absolutely. I'm a accounting major by education, and naturally went into back then. This is like late '80s, early '90s. It was the Big Six. Now it's down to the Big Three or what have you. But back then, I started out in Coopers & Lybrand on the auditing side, and I was auditing actually some very large funds. Fidelity. I was in the Boston office, so after graduation, I stayed in Boston area, and did that for a while. Auditing is tough. It's a grind. When you have your busy season, you don't see the light of day. You go to work at night, when it's still dark, and you come back when it's dark, and so it can be a little tedious. And so I quickly switched over to the finance side and started working with Solomon Brothers as an investment advisor, but a mini institutional investment advisor. So not really on the retail side, but more advising, bank treasury departments and how they could then take our advice and kind of filter that down to their clients.
And so what made you, it's interesting. I've spoken to two or three people on the podcast who have been with blue chip organizations like yourself, and then suddenly decided, hey, I'm going out on my own and I'm going to do this. So what made you make that decision, and then why real estate?
Yeah, so like a lot of people, you just gain so much knowledge working with the big companies, and then if you have that entrepreneurial bug, you just have it, and you start, instead of applying it as advice to other companies, you can use that same skill set that you've learned and apply it to your own company, and there really is a lot of crossover, between the type of advice I was giving when working with Solomon Brothers as opposed to in a real estate setting. And, that's just, basically the accounting side, being able to read a financial statement is always helpful when you're running your own business, just to understand it. I would encourage anybody who's running a business to take some basic accounting. But, the financial planning, the forecasting, there's a lot of overlap in being a real estate developer because you have to plan out, you have to look at the market, see where trends are going, interest rates, there's a lot of moving parts. And planning that out to be successful, it takes a lot of effort.
And Real Street Capital is not your first real estate venture, correct?
No. Look, my team, we've done 20 different real estate developments, 3,000 houses, like $1 billion approximately in total construction value over the last 30 years. We're well read in that. And Real Street Capital was really a way to kind of bring smaller investors into the real estate market, similar to what the institutional guys do.
Right. And as I mentioned earlier, this space is very popular with the CF and Reg A investors, the retail investors. As we know, you don't have to be an accredited investor to invest in CF and Reg A deals. You're doing a Reg A deal for Real Street Capital. So firstly, why a Reg A? What drew you to that instead of a Reg D, where you have institutional experience, which really fits in the Reg D space? You decided to go Reg A.
Yeah, sure. There's a couple of things going on. Number one, we're focused right now on the single family build to rent sector. And so that's a very prosperous sector right now because it's really getting some institutional inflows. If you look at multifamily, Institutions own about 55% investment into multifamily, but they're only 2% into the single family rentals, which is mainly made up of mom and pops. But you're seeing about $100 billion a year crushing into that market. And this is, the smartest money, the most savvy, institutional investors in the world. You're talking about, Blackstone, Vanguard, so I mean, it's pretty big and important companies that are doing it because they know what they're doing. It's higher returns. And so basically, you say why the reason, if you look at it, real estate really, I mean, the vast majority is Reg D. I mean, so yes, while regs, Reg A and CF are dominated by real estate, in reality, real estate is dominated by in Reg D. It's just the way they do it. It's less expensive to set up, a Regulation D offering than it is to go through, the process. We're just short of almost going like a mini IPO with the Reg A, but it adds a lot of safety net and credibility because you have a broker dealer, you have transfer agents, you have escrow, you have a lot of scrutiny. SEC reviews your document, FINRA puts their eyes on it, and so why did we want to do it? Because I think basically we wanted to get the smaller investor to have a chance at investing in the build to rent sector, which is really, like I said, dominated by institutions. And when I'm saying institutional, it's ultra high net worth individuals, and you're talking about funds. And so you need 50 million in money to get with a BlackRock and get into one of their big funds in this sector. And we kind of wanted to open it up to the small guy because it's the highest returns of any real estate investment right now. I mean, you talk about risk adjusted returns, so it's a really good area to get into, and Reg A seems like the natural fit.
So explain to me a little more, because this sector is not a sector I know very well. It's
Right.
not been something that I've been involved in with my previous experience in the financial services business and working with wealth managers. How does an investor maximize this, right? If I invest in real estate capital, what am I actually investing in? How do I actually make money from that investment?
Yeah, so I mean, basically, you're looking at a situation now with build to rent where you have changing demographics. So you have, what's called these individuals who are purposefully going into rental. So it's no longer, it's sort of renters by choice. That's what millennials are doing, and so you have that dynamic pushing on the supply on the uh, on the demand side, and on the supply
And
side.
Greg, let me stop you there, just so, and I apologize for interrupting,
Right.
but why is that change? Because it's something I've heard a couple of times in the last month or so, with people wanting to rent rather than buy. Now, is that because of the prices of houses now? Is it to do with interest rates? Is it a bit of both? Why is that happening?
Yeah, so it's a little bit of a confluence of events, and so first of all, we have a serious shortage of housing, 6 million houses short right now in supply, and there's a lot of reasons for that. Number one, it's the fact that people are locked in at super low interest rates, and they can't and prices haven't come down, so they can't sell their house because they don't want to get into a 7% mortgage when they're in at 2.5. And so people are kind of locked in. So that's really putting a strain on the supply side. Really, only place it's going to come from is new construction. I mean, there's unless something happens with interest rates, but nobody right now is even dreaming that interest rates are going to go back down to, let's say, 3% as previously. So it's something's got to give there, but there's also the sort of a mentality of the younger generation, the millennials, the Gen Xers, don't want the commitment necessarily of ownership, unlike the baby boomers who really wanted it. And so there's a little bit of that going on, but you definitely have a demand side coming in. And really what it is you have 72 million millennials coming into the market right now for the first time home buyers. And so you have the boomers coming out, the millennials coming in, but the boomers aren't getting out because they can't afford to downsize. When you would normally downsize, right? When your kids go off to college, you're kind of that empty nester. Um, those guys are stuck. They're kind of stuck in a bigger house than they would want. And obviously there's some movement. Some people just have to do it, but it's yeah, it's putting a real pressure on the supply side. So it's it's a lot of things.
Yeah, it's strange you talk about attitude there because I remember, growing up and my attitude towards buying a home is one of the things that my parents always told me. It's like, oh, that's your asset, right?
Yeah,
That's the thing. You got to buy a house.
yeah,
That's kind of a big step in like who you are and all of those elements. And it's interesting to hear that from what you're seeing, that mentality has changed through the generations.
right.
And I apologize again, I did interrupt you
Oh,
when you were asking my question about what an investor gets from this. So
yeah.
please continue.
Yeah, sure. So what's interesting about built to rent, it's like it's purposefully built to rent. So when you have an industry of the single family homes which is fragmented, meaning mom and pop, you have a myriad of different individuals who are landlords. They may have several properties, maybe one property. You don't know what you're going to get, and so even for the renter, it's difficult because when you go with a built to rent, which is professionally managed properties and newer properties, so newly built, you're providing renters with a superior product. You have streamlined leasing, which is online. They can go and pay their bills. They can request maintenance. You have very high efficient energy efficiency houses because they're newer, up to the higher codes, and you get better customer service. So what happens is renters, first of all, will pay a premium for that. So you're going to get a higher return on investment than you would from let's say someone buys a 1960s built house and rehabs it. They can get less than what they get in a brand new house. Um, there's less maintenance on those houses. So from the ownership side, there's less maintenance on a new house that's warranted and so forth. But what you'd get with investment would be you would be an owner of the house, so you'd be like a fractional owner. So it's a limited liability company. You would be one of the members of the company, one of the owners of the company, and then that company would own the houses. So that's really the structure of it. How it would work, and it's basically getting into institutional type returns that are not always available to the average guy.
So if I'm hearing you correctly, if I invest in a company like yours, right?
Yeah.
Invest in Real Street Capital,
Yes.
I can expect some sort of income flow on a quarterly, yearly basis because that's coming from rent.
That's right.
And then I can also expect if for instance, Real Street Capital decides to sell the various houses, then again, that's another way I can receive income.
That's right. So it's two things. It's like you said. It would be quarterly income. So you get income mainly from rents, and then once a development is built up and it's cash flowing, there's any number of large institutions, like from a massive institutions that would like to come up and buy a fully functioning and performing asset, and they'll pay a premium for that. And so that would really be the exit strategy for some of the assets. So there's two things there. There's income stream and then there's asset appreciation. And so both those things work hand in hand. And it doesn't have to be the whole fund selling out. It could be turnover of a certain portion of the assets and keeps others for income, but that's all done based on current dynamics and what's going on in the market and trying to maximize the investment for everybody.
And Real Street Capital is a fund, correct? You're not just doing one particular project.
No, yeah, it's a fund. So we look to opportunities, and it could be a joint venture with another group. It could be structuring your own properties, building up developments from scratch. Yeah, so it kind of runs the whole gamut of opportunities that are available.
And are you looking at particular regions, particular states that you feel are at the moment going to be a boom for this?
Yeah, so we're not limited to any specific region, formally limited, but we are focusing right now on Florida, and so it's that Central Florida area. It's right in the path of progress. So yeah, there's a lot of opportunity there. A lot of people moving there. A lot of retirees. A lot of millennials. We're around some college towns. Gainesville, Florida, University of Florida has a significant population, so we're looking in that area. But yeah, there's basically Florida is where we're looking right now, and we have some interest in Georgia. But we've also had some deals come up, interestingly enough, in Chicago. So it's sort of where the opportunity takes you.
Yeah, it's interesting because I was talking to someone the other day in your space, and they're focused on Michigan. And I was like, really? Why aren't you in Florida? Because it makes sense to
Sure.
build in Florida, like you say, especially if it's like an over 50s situation. And they were saying that the need in places like Michigan now are growing because people are coming back. Where
Right.
you used to get people buying houses in Florida, some of those people now have decided they want to move back because their kids are in Michigan or wherever the case
Yeah.
may be. Are you seeing that trend change? Because, as I say, you speak to most people, you go retirement. Yes, it's Florida. It's
Yeah.
it's down in the warm states. Are you seeing that slowly change? That people are looking at areas that haven't been looked at previously, or are going back home?
Right. So I haven't seen that as a trend, but that always happens. So I mean, like people have to live in Michigan. There are people who live in Indiana. So yeah, there's always a need for construction. There's always a need for home ownership. There's always a need for uh, for development in every area. And like I said, we're 6 million housing units short right now of what we need. And so that's not just Florida. That's all over the whole entire country. And so yeah, it definitely happens. People moving back. Everyone has their situational story. But in general, the trend has been, moving to the warmer climates, moving to the lower tax areas. So, you see a lot of Texas, developing. You see a lot of Florida, and you see a lot of the places in the traditional like northeastern big cities, moving out, and it has a lot to do with just a shift in desires for lower taxes. I think is a big part of it. Florida has no state income tax, so that can help a lot, and it doesn't have really burdensome property taxes either. So, you go to certain places in the Midwest, for example, and you can see a pretty high income tax, and guess what? State income tax, and then also you get the same property taxes are high. So it's not like one necessarily cancels out the other.
And do you think, it just popped into my head, do you think, with what we had with COVID, everyone being at home, working from home, has that also, do you think, actually led to this change in people not wanting to buy and rather rent because it's easier to move around?
Yeah, I don't know. I don't know how it affects the renting versus buying, to be honest with you. But I definitely there's a huge trend now, and there's a big scary thing coming up in the commercial office space. When they get hit with their refinancings, I mean it's in the trillions of dollars, and they've got a lot of empty. I mean that's a little scary for the market. But yes, people now realize that they can be mobile. In other words, I have a great job in New York, but guess what? I can sit in Central Florida at a fraction of the price I'm paying in New York and still make the same income. And so people are just working more from home. And it's interesting because we're actually building our houses around some of that change. In other words, we're making bigger areas for either a study room for kids who may be homeschooled, which is increasing slightly, not as fast as working from home. But it could be a dual space, it could be an office space, it could be, so there's a lot of that sort of change in attitudes and way of living that's affected the way we build, and so we try to accommodate that.
And you mentioned the office space, and I must admit I've been to a few cities recently where what's happening with that office space, because no one is using it, is it's being sold and turned into condos and so forth. So is that something that Real Street Capital would look at, is maybe picking one of those up and turning that into a for rent situation?
Yeah, so we've looked at that. The big issue with that is it's extremely expensive to convert, and it's not only expensive; it's a tricky thing, from an engineering standpoint, and a lot of it, PKW has to do with the bathrooms. So in an office, it's plumbing. So you're talking about the guts of a building, depending how tall it is. You got to put a lot more bathrooms in when you're talking about apartments versus an office space. I'm not talking about the amount of the flow. I'm talking about the location. And so Yeah, it can be logistically a nightmare to convert. It can be done, and it has been done, and I think something has to be done. But it's not as easy as people think. Oh, let's just turn this office space into an apartment complex. Okay, well, there's a lot of considerations physically that need to be addressed. Yeah,
And so, as we touched on earlier, this is not your first rodeo in this space.
right.
Is it your first rodeo as far as using Reg A? Have you used Reg
Yes.
A before?
No, we Reg D is what we do, and so we typically talk to a family office or talk to high net worth individuals. And you don't even have to do like a advertising Reg D. Normally, when you have a project, you'd come together, you'd have your investors lined up, they'd all just agree. They're all sophisticated, investors, and you're done. You do your deal. This is the first opportunity to give to the what I would call the general public, and it's not limited by any kind of income test except for a regulation A. I think the limit is 10% of your income, and so but that's self-reporting. And so as long as you say, here's what I make, and okay, then we limit you, say, look, don't go crazy, don't bet the farm on any one asset class. Invest prudently and put a percentage of your income into one area.
Yeah, and when's your Reg A being launched? Is it January?
Yeah. So right now, I'm anticipating. So we had the final, I think, letter going back and forth with the Security and Exchange Commission, and so I think we're looking at a January 1st launch. I mean, there's no sense launching during Christmas or the holidays. We won't get people's attention, so I think we're looking at a January 1st launch date approximately.
Excellent,
Yeah,
excellent.
we're very
Well,
excited.
this has been very, very informative. Thank you
Yeah,
very much for your
thank you.
time, Greg. I wish you the very best with your Reg A raise, which I believe is via NetShares.
Yes,
Again, if anyone is interested in investing in Real Street Capital, they're going to be able to find out more information either via Real Street Capital's webpage or via NetShares' webpage coming in January. Thank you,
that's
Greg.
right. Hey, thanks so much, BK.
Thank you.
Take care.